Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at the outlook for U.S. railroad transportation, telecoms, and cloud computing business for 2026.
Plus, we speak with the writer and producer of the film Bull Run on capturing the excess and high-octane world of Wall Street.
But first, we lean into the world of luxury. According to the most recent Bloomberg Intelligence research, the recovery of luxury goods makers in 2026 hinges on limited price increases and a shift toward volume-led growth.
For more, Paul and guest host Nora Melinda spoke with Deb Aitken, Bloomberg Intelligence luxury goods analyst.
We started out 2025 with an expectation that we'd move back to growth, and that certainly didn't materialize through the first half of the year. But we seem to be ending at around 3 to 4% growth as we exit 2025. Now, the US has been robust, Middle East doing very well, but particularly in the first half of the year, it was China which was the drag. And what we've noticed as we end the year, we've actually just heard on a fireside chat over the last few days from L'Oreal, where they're mentioning high-end beauty doing very well out of the US, but also in China too. So they're adding to what we've heard from the luxury companies, where we've seen 2/3 of luxury companies and most of the top 10 switching to growth in China in Q3 from a low base, from negatives a year ago, but actually that we're calling green shoots into the end of year.
How are these companies holding up as it relates to tariff overhangs?
Yeah, so we did a lot of work around May time and again through July and August with the different tariff rates moving around. And what we've actually seen, it was less detrimental overall in our numbers. We probably think that EPS won't be pulled as much as was expected because there have been some cost savings. And the biggest companies and those that were where brands were really in favor have managed to pass on price. And generally, because these companies operate on high gross margin, the cost into the US, they've moved around 2 to 4% on additional price into the US, as well as 2 to 3% from the beginning of the year. So some of those brands have absorbed passing through 6-7% pricing to the US consumer. And we think into 2026, that moves nearer to 2 to 3% overall. So it should be less intimidating for the consumer overall 2026. So it's one of our drivers for the year ahead.
Deb, talk to us about the Chinese consumer. Are they not traveling? So is that an impact for New York and London and Paris and things like that?
We actually have a survey out of our Asia office that we've just incorporated into a travel document, which we'll be producing, but this piece of work is already produced. And actually, on October versus May, the China consumer is looking to travel more into Europe to start with. So that's the first big positive. I think part of that is just on the way the tariff situation has gone, maybe. So that will be the first time that we're looking for them to come back. So versus 3 months ago, they're looking at traveling outside of Asia. But overall, what we call the China cohort, that's actually really operating more avidly across the Asia region. We're not seeing so much travel from Chinese into Japan. And of course, we know that there's some political commentary there as well. So we wouldn't expect that to pick up next year, but we are seeing Korea, Singapore, Australia and others being positive. And the first move to Europe should hopefully indicate that towards the end of the year and as tariffs settle more in 2026, that we see some of that return to the US as well.
And sticking with China, how are we thinking about supply chain operations as it relates to a lot of these luxury firms, especially stemming from China?
Yeah, so if we think about maybe if we look at it from some of the aspirational entry level luxury companies, then they will have some production moving around the Asia region. But if we think about the heritage, traditional, higher end luxury companies, then most of their production is France, Italy, some Portugal, some parts of southern Spain, not so much going on in the Asia region. And so they've been able to manage on the 20% tariff from made in Europe over to the US more so than some of the peer group. For example, one of our entry level that we call branded affordable jewelry, Pandora, produces out of Thailand. It's really suffered in terms of share price this year versus some of the Asian retail jewelers who've done very, very well on the price of gold.
So you got to explain this whole handbag thing to me, Deb. I was in Italy in September. We toured some factories and artisan shops where they make these handbags, and they sell them for tens of thousands of dollars and euros. What is going on there? Who buys that?
It has. I always say, if you bought a Hermes, you have a just as good or a better correlation than if you'd have held gold. So I think that these bags, particularly for sought after material, the craftsmanship, and the fact that they have continued value, are seen as investment pieces. And so we have the middle ground. If we look over the last year, and one of the things that we think for 2026, bags from Tapestry, from Coach, Ralph Lauren, others, as well as ready to wear, have done very, very well, resonated with the consumer who's been a little bit more skeptical on the consumer sentiment side and maybe shopped around $1,000 or so. But at the very high end, there hasn't been much of a move. So we've seen Hermes, Brunello Cucinelli, and others doing very, very well at that high end.
Our thanks to Deb Aitken, Bloomberg Intelligence luxury goods analyst. We move next to a conversation with Jonathan Goldstein, co-founder and CEO of Cain International. It's an alternative asset manager specializing in real estate investment solutions.
Jonathan's real estate and experiential investments have helped him morph into sports-related investments. In 2022, he also became director and co-owner of Chelsea Football Club, a prominent soccer club in the English Premier League.
He shares details about his new club and what it means to be part of a growing ownership group.
Oh, well, I'm on the board of Chelsea, and obviously the buyout was led by my partner, Todd Bowley, and in partnership with Clearlake back in 2022. The team's doing well. Obviously, huge success in the summer in New York, winning the Club World Club Championship, which was a proud moment for the fans. The women's team done extraordinarily well, winning the Women's Premier League for multi-times in a row last summer. So, we're very proud of the development since we've been involved in 2022, and we think there's more to come. We're very excited.
So the valuations on some of these franchises, whether it's huge franchises like in the English Premier League or the National Football League here in the U.S., just beyond the realm of arguably even 100 millionaires. These are billionaires, if not private equity, corporate money. So that leads some people to say, hey, I'm going to go to some of these smaller sports or where I can maybe get some better value. How about cricket? Trent Rockets. What's the play there? And I don't know. That's all I got for cricket.
First of all, let me explain the way that the 100 competition works that we've invested in and try and put it in American language.
Please.
Let's assume you have a baseball game where you have 100 pitches per side. And the objective is to score as many runs off those 100 pitches as you can. It's a short form nature of the game. Sure. 2 to 2.5 hours. Exciting. Every pitch is important. And this is what the English Cricket Board created 5 years ago in London, in the UK, with 8 franchises around the country. Now, it modelled itself on the Indian Premier League, which obviously has been a phenomenal product for the Indian population and globally for those who like cricket. It has the second most valuable broadcast rights per game in the world, behind the NFL, on a per game basis. There are larger broadcast contracts, but not on a per game basis. So we have watched this competition in the UK, and we thought there was a significant opportunity for us to get involved, add value.
Nice.
And we watched other people get involved, obviously, and there's, of the 8 teams, 4 of them are owned directly by Indian Premier League teams. Okay. One of them is owned by a group of what they call themselves the tech titans from the west coast of America. The Microsoft CEO, by way of example.
Okay.
And so, a lot of Indian heritage love cricket.
Yep.
And so we thought, here is a significant opportunity to create the baby product to the IPL and over 5 to 10 years grow that. It's a great window of the summer in the UK. Obviously, you have to, just like in America, a good external climate to play cricket. You want it outdoors, and you can't play in the rain, just like baseball. So it's a great time, mid-July to mid-August, where there's a window for an opportunity to build huge product and broadcast and spectator. And I think what's really important is that you're building it in a country which has an undercurrent of love for the sport. So therefore, you're building off a good base.
Thing for me to go see. I'm not getting out to see a cricket match.
See a professional cricket match.
I'm going to invite you next summer. I think what we're doing here, and playing back to your initial question, we've watched the valuations of the NFL teams, of the baseball teams. I mean, Todd obviously led the way with the Dodgers, over 10 years ago at just around $2 billion, and we've seen what trades are happening today. We saw, the valuations been put on the NFL teams recently, and even the MLS is trading at very high levels. So, you try and see a situation where you think you can add value and grow a franchise and grow a business.
Jonathan, do you see a future for cricket in the U.S.?
I think there's a future for most sports in most places. It depends upon the depth of demand and the depth of local participation. I don't think you can just pick up a sport and put it in each country unless there is an underlying desire. But in my view, there's a much greater opportunity in the UK because of the inherent nature, the love of cricket that people grew up with.
The history,
and I
the
think
culture.
there's so much competition in the US for, again, basketball and baseball and football and all the major sports. I think the MLS has made a breakthrough, but it hasn't really got up to the top table. And I think if you look at how many years that's been at it, I think cricket will find itself even harder to get to that top table in the US.
You go to any of the parks in Queens, Brooklyn.
Across the street from my house.
World-class cricket dudes out there.
Yeah. They're playing every Sunday and every Saturday.
Yeah, it's crazy.
I think Americans have had a view of cricket overall, which is wrong.
Right.
It's an amazing sport. Even the 5-day variety is probably the most enthralling sport you could ever watch.
Yeah.
And I think that cricket is a growth area, and that's why we put some money behind it.
Our thanks to Jonathan Goldstein, co-founder and CEO of Cain International.
Coming up, railroads on the move, telecoms in orbit, and gaming in the cloud as we look ahead to 2026.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We start on the rails. Heading into 2026, North American railroad companies are betting on precision, technology, and cost control as they navigate steadier demand.
According to the latest Bloomberg Intelligence research, North American railroads' earnings growth look poised to pick up next year, but may fall short of double digits because of President Trump's tariffs.
For more, guest host Christine Aquino and I are joined by Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst.
We're thinking that next year is going to be a better year, but it's not going to be a great year. So earnings for the rails, broadly speaking, increased by mid-single digits. We expect that to accelerate to high single digits. I think investors would really like to see it get it into the double digits and even mid-teens. But I think we might be a ways out for that for a while, and that's really being driven on the demand side. We're really expecting tepid demand across the board at low single-digit growth. Some rails might do slightly better than others, like CSX, which has easier comparisons versus this year, and Canadian Pacific, which has a lot of synergy opportunities following its merger with Kansas City a couple of years ago, and they're still working through some new business opportunities following that merger. So those two rails will probably outperform when it comes to volume growth, and you could see flat growth from a rail like Norfolk Southern, which is dealing with possibly some lost share on the intermodal side and some tougher comparisons when it comes to export coal.
Yeah, well, very interesting, Lee. Of course, still a challenging outlook, it seems like, for the rail sector next year. How do tariffs play into that outlook? Because we still don't have a lot of clarity on whether tariffs are going to stay, but if they do, how could that disrupt the outlook for rail in 2026?
Yeah, so it's impacting rails differently. It's impacting the Canadian rails, Canadian National and Canadian Pacific, Kansas City, or Kansas City Southern. They're impacting them, kind of on if you think about it, forest products or metals or autos, that's being negatively impacted. And if you look at Union Pacific, if you have inconsistency with imports coming into Southern California, that's impacting them. So, it's really creating a level of uncertainty among shippers, and that's creating, what I would say, not allowing the rails to operate as fluid as they possibly can because of that stop and go demand.
Lee, one of the big topics in the railroad industry, and I think it'll be most of the year, is the proposed Union Pacific Norfolk Southern M&A transaction here, creating the first east-west coast-to-coast railroad in the United States. Is this even going to get approved, do you think?
We're kind of cautious on that. I think we have like a 40-45% probability that the deal gets done, and we're well below consensus, we admit. We might be a little naive thinking that, the STB will remain neutral when they take a look at this deal, because the parties have to prove that it's in the public interest and it's going to enhance competition. Some could argue that some of that enhanced competition is going on right now because you've seen Burlington Northern, which is a competitor in the West, teaming up with CSX to provide coast-to-coast services, not through an acquisition, but through more of a collaborative effort. And you are seeing, CSX winning some share from Norfolk Southern based on that.
Yeah, well, if that does not clear the regulators, Lee, what do you think that will say about the future of potential consolidation or strategic partnerships across the rail industry? Is it kind of, do you think people are going to see it as a one-off sort of situation, or is it kind of a harbinger of challenges to come when it comes to M&A in this space?
Well, the STB raised the bar for large Class 1 railroads to merge back in 2001, and that was really driven on some service issues from past mergers. And so, that's why the bar has been set so high. All the other railroads, obviously they're talking their book, but they think that they can create a better network through collaboration. We think that it can happen through a merger or through collaboration, but like I mentioned earlier, Union Pacific and Norfolk Southern still have to clear that high hurdle that it enhances competition, and it's also in the public interest, which is, again, it's really tough to prove. Also, we expect that we probably get an answer about whether or not the STB, or the Surface Transportation Board, will approve this deal in early 2027. So we'll be talking about it all year, and I hope to talk to you guys about it all year.
Our thanks to Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. We move next to the telecom and satellite space. Bloomberg Intelligence recently put out its outlook for U.S. telecoms and satellites in 2026.
According to their research, slowing wireless service revenue gains and mounting cable competition are prompting a deeper push into broadband for growth as U.S. telecoms enter next year.
For more, guest host Alex Semenova and I were joined by John Butler, Bloomberg Intelligence Senior Telecom Analyst.
So I think the big thing to keep in mind here, Paul, is as we roll into 2026, I think we're going to see price promotion take a modest step up. The bullets are really flying in wireless right now. I think part of it is AT&T and Verizon both have new CEOs. Both CEOs are going to want to make their mark. I think the one to watch is Dan Schulman at Verizon. He is very focused on volume. He wants to get Verizon back to subscriber growth. And I think the only way to do it is going to be by promoting a little bit more aggressively than they have in the past.
John, where do you see the strongest incremental demand coming from? Is it going to be mobile data? Is it going to be broadband?
Two areas, Alex. One, as you touched on, is broadband. That's a real growth vector for the telecoms. If you look at fixed wireless access, which is delivering broadband over a wireless link into the home, that has proven to be exceptionally popular with people. So I think all three telcos are going to lean into broadband in order to supplement the slowdown in wireless growth. But the one area I'm watching as we move into next year is satellite. Starlink is partnered with T-Mobile. The two of them are already offering limited texting service on a nationwide basis. It's sort of early stages there, early innings, if you will, for them. Verizon and AT&T are partnered with AST Space Mobile, which is in the process of launching its constellation now. They actually have more better satellites than Starlink, and so the space race is on, as I like to say. It's going to be really interesting to see once Verizon and AT&T are able to launch services early next year, how that market segment unfolds.
So the wireless operators, the Verizons of the world, the AT&Ts, John, they're partnering with some of these spaced satellite services?
Yeah, I mean, I think the way to think about it, Paul, is it's almost like cell sites in space at this point.
Yep.
So the major carriers have partnered with Starlink and AST to provide that infrastructure and the transmission capability up in space to be able to provide coverage outside the range of terrestrial networks now. So essentially that concept of coverage everywhere is going to become a reality as we move through next year.
I will say I was getting a new iPhone in T-Mobile. I'm still grandfathered into my father's plan. They're very lucky, still paying for my cell phone, but they immediately offered me to get Wi-Fi with them, with T-Mobile. So it's really interesting and a new offering from them, as you mentioned, cool. John.
Is there a 6G out there? Because I think I've grown up and we've had 3G, 4G, 5G. Is there a 6G out there?
Not yet. I think 6G is going to move onto the horizon probably as we move through next year. It's a development process by the industry. And so that standard, if you will, is getting developed now by industry committees. It will then move into test probably in 2028 and become a reality for us by 2030. Right now, we're mid-cycle with 5G. So if you think back to when 4G was originally launched, it was much lower speed than it is today. So that standard, those generations of mobile, evolve over what are typically 10-year cycles. So we're mid-cycle with 5G. Expect better speeds and better performance there as we move through the next 5 years. And then ultimately 6G will appear probably again in the 2030 timeframe.
Our thanks to John Butler, Bloomberg Intelligence Senior Telecom Analyst. Now we move to the cloud gaming space. Bloomberg Intelligence has recently put out a deep dive into cloud-streamed gaming and specifically how AI could accelerate game development with a shift toward cloud-based games.
This development could, in theory, make physical gaming consoles obsolete. For more, we talked to Nathan Naidu. He is Bloomberg Intelligence Technology Research Analyst.
Consoles will decline gradually, and that's what I mean, and kind of remaining over the long term as a niche device for loyal fans, the really hardcore gamers, as advancement in cloud infrastructure, and we see what's happening with data centers, as well as a wider spread of mobile gaming, playing games on mobile devices, whether smartphones or tablets, as that gain wider spread, and people become less interested, in playing games at an unportable gaming hardware that's stuck at home or living room. If they can do so and have the same experience on a mobile device, why not, right?
So where are we in kind of that evolution in terms of really putting more and more of the content, of the technology, of the capabilities in the cloud? How is that changing the gaming experience, the gaming business?
Yeah, so the key pain point to cloud gaming is network latency, because that literally depends on the distance between the user's hardware, whether a mobile device or a console, to the nearest cell tower. And we know that 5G network coverage are improving not just in emerging markets, but also becoming better in even developed markets, including China and the US. And so as that infrastructure and also cloud improve, because this proximity to data centers also is a factor in determining the experience of cloud. So far, in emerging market, there is a pain point, but we're seeing really huge uptick in coverage footprint, whether 5G or 4G LTE in markets like India and Middle East and Latin America. So that just support our conclusion that, in the next 10 years, the experience, that pain point will become better. And also, let's not forget that, mobile phones, mobile screens capture, a lot of our attention economy. Actually, there's a study according to Harmony Healthcare IT that it captures more than 5 hours of our time every day, and about 20% of those time actually go to gaming among Generation Alpha and Generation Z, and they are the bulk of the gamers. And also, these gamers don't really care about playing games at home anymore if they can play on mobile, because what they care about is access and also being able to do things on their mobile devices. So I feel like with this generation coming up, and entering into the workforce, and they are the one who would see spending power increasing. And I feel like there's a lot less inclination to actually play games on a console if 10 years down the line, you can have the same experience playing games on a mobile device.
Our thanks to Nathan Naidu, Bloomberg Intelligence Technology Research Analyst.
Coming up, from factory floors to farm fields, how U.S. machinery makers are positioned for 2026.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
Let's turn now to U.S. machinery. Heading into 2026, the outlook is defined by softer demand, but steady investment in manufacturers focus on automation, replacement cycles, and cost discipline.
For more on this, Paul caught up with Christopher Ciolino, Bloomberg Intelligence senior U.S. machinery analyst.
We believe that the U.S. machinery earnings are likely approaching a inflection point in 2026, really after a multi-year downturn. Despite lingering tariff headwinds, the prospect of lower interest rates, policy and regulatory clarity, normalizing inventories, and better pricing have really provided a favorable setup for most machinery producers heading into 26. I would say the outlooks do vary a little bit by end market. We're most constructive on the outlook for construction equipment next year, particularly as non-residential construction markets approach a trough. You also have favorable secular trends around power generation, infrastructure and mega projects, as well as some of these reshoring investments. So we have really good visibility in terms of 26 and really even beyond. On the flip side of that, we're a little more cautious on the ag equipment outlook. And then I throw, commercial vehicles somewhere in between there.
Equipment companies, I think about Caterpillar, for example, and that stock's up 54% year to date. So has the market already discounted the cyclical upturn, or is there more to go?
Yeah, I think there's a lot of runway here. There's been a lot of optimism around their power gen and exposure to the data center market. But I think we're still very early innings in this story playing out. They're going to double their large engine capacity here through the end of the decade. Gas turbines are going to be up 2.5 times. You're just beginning to see some of these products come to the marketplace. And really, there's just insatiable demand for power generation. And I would say Caterpillar and Cummins are somewhat uniquely positioned within the machinery space to kind of capitalize on these longer-term secular stories.
Yeah, that is a long-term secular story, power generation. So did they disclose backlog information or anything like that to get a sense of kind of how big this business could be for them?
Yeah, so Caterpillar's backlog for the enterprise is at a record level, and it just continues to, set new records with each passing quarter.
Wow.
In terms of their actual power generation business, no, they keep that pretty close to the vest. But it does extend multiple years, and the fact that they're making, essentially more than doubling their large engine capacity through the end of the decade, just I think lends support to. They have very good visibility for several years out. And same thing, I would allude to that as Cummins as well. They have very good backlog visibility in terms of their power generation business. And then you throw on, the cyclical recovery that we should see in these businesses. It's a pretty favorable setup, not only for 26, but beyond.
All right, you mentioned the other part of the business, or a different part of the business, that one that focuses on the agricultural sector of the economy. We know the farmers in a really tough spot these days, and when they face financial difficulties, they're not buying Deere tractors and things like that. So what's the outlook there over 26?
Yeah, right now we anticipate that the large ag market here in North America will be down another 10 to 15% in 2026. So this is going to mark the third year of a downturn. And really, to put things into perspective, assuming we're down another, double digits in 26, volumes are going to be at the lowest level in more than 4 decades, or as long as we've been tracking the industry. So I do think there's pretty high degree of confidence that this will mark the trough of the cycle, and we actually think that downside risk is probably limited here and relative to a lot of the other sectors that we cover. The problem is, farm fundamentals still remain quite weak. Crop prices are still low. While the government still continues to, hand out additional aid payments, farmers historically don't use this to go out and spend on new machinery. But we think really the bigger overhang here is still the lingering export market uncertainty. We did have a U.S.-China trade agreement. I think farmers are really just going to take a wait-and-see approach. And until we get tangible progress on, China executing on some of these purchase orders and commitments, I think farmers are just going to be hesitant to go out and spend on equipment. When we do see that come to fruition, hopefully then you'll start to see a rebound in crop prices, and then maybe we could become a little bit more constructive on the equipment outlook there.
So just to put a bow on that, Chris, we got about 30 seconds left. What is the export market for the U.S. farmer generally on average, and what is it today?
Yeah, so we export the vast majority of, particularly our row crops. Soybeans, China is still the largest buyer of our beans. We do send a lot of corn to Mexico and Japan as well. But those big row crops, corn, soy, wheat, that's what really drives farmer profitability. It's more than half of U.S. crop cash receipts. And we need to start to see some kind of a rebound there before I think we become a little bit more positive on the outlook.
Our thanks to Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst. We shift gears now to the creative side of financial storytelling.
Wall Street has long been a backdrop for films exploring ambition, excess, and high-stakes drama, from The Wolf of Wall Street to Margin Call and The Big Short.
Now you can add another to your list. It's called Bull Run, a film based on the memoir entitled Discussion Materials, Tales of a Rookie Wall Street Investment Banker. For more, we caught up with the film's writer and producer, Bill Keenan.
So, like all those movies, classics, right? Bull Run has an outsider as a protagonist. So we kind of have that journey of someone entering this world, trying to figure out what to do and where they fit in. I think the difference is a lot of those films follow that story of kind of, there's this crazy excess, there's ultimately this corruption that happens, and then redemption. And the protagonist in Bull Run really retains this outsider's perspective, which is the way I experienced it. I kind of saw life through the eyes of a storyteller and tried to maintain this distance. And I think we tried to do that in this film. So it's not so much about the corruption as it is about just observing the absurdity that goes on in this world.
So you were on Wall Street. Tell us what you did in Wall Street and how that might have influenced kind of this project.
Yeah, what I did. Well, by title, I was an investment banking associate in the industrials group at Deutsche Bank. We parted ways after about 2 years. I think it was mutual. It wasn't for me, and it wasn't. They weren't sad to see me go, but it was. I mean, the beauty of Wall Street is that, again, as a storyteller, it's such a combustible environment. So everything is so urgent and is life and death. But then it's like, this is a specialty lubricants deal, and like it's not. It's okay if it doesn't go through. But it's fun to be a part of, and I knew the second that I started, this would be so ripe with anecdotes and characters that it was, I needed to stay long enough that I could get enough material to write about it.
I kind of think of your book, Discussion Materials, as a 2020 version of Liar's Poker, except instead of bond traders, you're writing about investment bankers. So when you were there, I mean, it sounds like you decided early on that you're going to take notes and observe everything. What were you doing in meetings? Were you taking notes on what people were saying, or were you kind of engaging in, the lubricants deal?
Yeah, I mean, I think like this. I was always commended at the beginning by like the staffers and the senior bankers because they saw me with the notepads, and every day was a new notepad, and of course they didn't necessarily know that I wasn't taking notes on the content as much as like who was doing what and what would lend itself to a story. But it was, it felt like it was a lot longer than 2 years, but I got enough out of those 2 years to,
and
create a story.
They packed a lot in 2 years because you're working round the clock, weekends.
You're working, yeah, and I like to kind of, the way that I try to capture what the experience was like. The first day that I showed up, I didn't even know where my desk was, and I'm kind of going around this maze of cubicles, and I get called over to the staffer, and he says, here's an address and here's 3 names. And ultimately what I was tasked with doing that first day was taking around these 3 energy executives through Midtown Manhattan. They were starting a new venture, and they were looking to raise like a couple $100 million from these private equity firms. And so I said to the staffer, we just met, I don't know what's going on. And his response was, definitely don't tell that to these guys. Like, as far as they know, you're a full-timer and you've been here for a long time. And so, being thrown in the deep end, then ultimately meeting these guys and feeling that responsibility, it was, you feel accountable. Tuesday, I show up, I get staffed on a fertilizer deal, and I had 2 tasks that day. I do find my desk. I sit at my desk for 12 hours. And the first task is to chart the cow dung spot prices historically over time. And the second thing is the managing director in that sector, he had recently undergone gastric bypass surgery. He lost about 80 pounds. And so I had to change the photo of him in the team pages of all the decks. And I'm thinking Monday, Tuesday, what's Wednesday going to bring? But like, this is gold.
It is gold, but and this is why it's so great talking to you, and the book is so fantastic. You also chronicle participating in these odd meetings with managing directors, updating Excel spreadsheets at 2 a.m, reformatting the font in pitch books. I think about all this and how OpenAI in 2025 is hiring former investment bankers to train its models and presumably replace the need to hire people like you to handle these mundane tasks. Is that a good thing?
I think all these things are going to need oversight, like we know, but I mean, the reality is we were sort of outsourcing, and not to AI, but to all these other companies and other countries, and they did a lot of my work, to be honest. I kind of took credit for most of it and changed the names and made sure everything appeared as though I had done the work. But anything that makes it more efficient and gets kind of people out of the way when they don't serve a purpose that's additive, I think is useful.
Yeah, I've been telling Scarlet, the first 2 or 3 years I was an investment banking associate as well after business school. I felt like most of what I did can be outsourced to AI. Sorry to say, but I mean, do I need to be sitting at the printer at 2 o'clock in the morning on a Tuesday? I mean, can AI do this for me?
But totally. The fact is, though, to have that experience as a human and to pay your dues, there's huge value to that. And you hope that there's a way. I think the way humans are, they always find a way to go towards struggle.
That's what I tell my kids who are in the workforce now, and the whole work from home versus, I'm just like, go to the office. All my memories are sitting at the printer. And the guys I sat at the printer with at 2 o'clock in the morning on a Tuesday night, they're still my best friends. The guys that I can call up and they will, if I need anything, boom.
Yeah.
That's how it goes.
Band of brothers, really.
Yep.
So, Bill, when you adapted this into a film, what was that process like? I'm sure you could write a book about that process too.
Yeah, I mean, there were practical issues. We shot it during the pandemic. So this was an independent film shot in one location. So we're all over each other. We got the masks on. We had to shut down production, in fact, for a couple of days. So there was that. We got through it. As far as the story, so much of my experience was me versus Excel, me versus PowerPoint, me on the phone with somebody telling me the numbers didn't tie, I screwed this up. And so there's a lot of internal drama that's great for a book, but does not lend itself to a visual medium. So the director did a great job of really retaining the spirit of the book and the humor and how I viewed that world, but then putting it in a visually compelling commercial sort of feel.
Our thanks to Bill Keenan, writer and producer of the film Bull Run. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.